Okay, and welcome back, students who are taking Math for Business and Finance and Math Applications. And we're working on the theory videos for Chapter 21, the Stocks, Bonds, and Mutual Funds chapter. And as always, if you don't understand something, feel free to pause, rewind, watch the video again. And if you still don't get it, then feel free to either telephone or contact an instructor. Okay. And in the last video, we were, well, actually, in this subset of videos, we're talking about stocks. Okay. And for those who watched the last one and last video, and we're kind of like paying attention, we had covered common, preferred, and stock, and you'll notice that I added in stock options here. Okay, I decided to make that quick little change here because basically stock options are not stock itself, but there is an options market in the uh, in the marketplace, Wall Street. Okay, you can, options are, how can I put this? They give you the option to buy or sell at specific points in time. And I'm not going to get into options because, again, that's going to be something for another subject, down the road in your education. But I do want you to, I thought I'd stick it in here because, options, we've all heard about or we've seen on TV or in the movies where, oh, you're going to get stock and options. And what options are, allows you to, let's say the option is that you're given, say, 10,000 shares of options at a price of $5. Okay. Well, you're given the options because you don't know whether the price is going to go up or the price is going to go down. Obviously, if it goes up, say to 50, you're going to want to exercise that option because you're going to get this gain between the 5 and the 50. Okay. Um, if the price goes down to say 1, all right, you're not going to exercise your option because you're losing money. Okay. So, that's what options are, and they're generally for sophisticated investors, and they're also given as part of compensation packages to the upper management. All right, but beyond that, that's all I'm going to say about options. I'm not going to get too much more into that. Okay, all right. So with stock, okay, and we'll talk in terms of the common stock here. There's three terms, and you won't see this in the textbook. This is not in the textbook. There's three terms. There's issue, authorized, and outstanding. Okay. Um, when a business first offers, and it's easiest to talk in terms of this when the business first gets started, to, to give this as an understanding. A business will sit down and say, well, let's decide how many shares of stock that we could possibly ever use. Okay. And for a little small mom and pop business, you might say, well, let me say have 1 million shares. Okay, um, let me take 1 million shares. Okay, so I'm going to issue 1 million shares. Now, issue, it doesn't mean anything. That just means how many are available. Okay, it doesn't do anything. It's just a way to get the shares on the books. Okay, now what happens if they run out of shares? Well, they're able to issue more. Okay, but for a small mom and pop, that's, and remember, large businesses, I mean, you think about it, how many huge businesses like Google, Facebook, Microsoft, Dell, there's not that many that reach that point where they have to, issue more. I mean, is it possible? Yes, obviously. Okay, but for the average company, if they say, 1 million shares, that's all they're ever going to need. Okay. Um, or 10 million or whatever. They just choose a number and that's what they issue. Now, when they decide, okay, that they're going to want to have, in order to use some of those shares in order to get money, they'll authorize them. So let's say they'll say, okay, out of those, I'm going to authorize, um, say 100,000 shares. Okay, and that's an authorization. I don't have money for it yet. But when I sell them, that it allows me to sell up to the 100,000 out of the 1 million. Okay, and as I sell those shares now become outstanding. So whenever you're looking at common stock or you're looking at an annual report, you'll see see these terms. You'll see, outstanding stock is how many you've sold. Maybe I have authorized of 100,000, but I only sold 50,000 outstanding. Okay, that there's an ability to have 50,000 more. Okay, so you'll see these terms. Um, they do play a part, but that comes into accounting purposes down the road. And right now, um, that's not that important to us. And if you're an investor, I mean, it is something. It's like a back burner kind of thing where you have to pay attention to it, but it really doesn't factor in all that much. But I just wanted you to be aware of this terminology as it applies to stocks. Okay. Now, um, stocks also have dividends. Okay. They pay, they may or they may not pay dividends. That's up to the company. And so what's a dividend? Well, a dividend is when the company has, they take some of their profit or their loss. And remember, people are investing in the business to get a return on their investment, their ROI. Okay. And so when a company is doing well, the company, if they make a profit, it's up to the management to decide whether to invest that money back into the business or to reward not reward, or I mean, that's what they call it, reward the investors for investing in the business. And remember, if the investors aren't being rewarded, they're not going to keep their money in the business. So they have to make a happy balance. And in order to do that, they decide upon dividends. All right, they decide to pay out dividends, which are called stock dividends. Okay. Um, they might say, okay, if I had $100,000 in profit, okay, and maybe I'll pay out $20,000 as dividends to my investors, okay, and you'll see what that means in just a moment. So they'll take that 20,000, the difference between the two, this 80,000, they'll reinvest back into the business, okay, but the 20,000 will be returned to um, the shareholders. Now, it can be returned in one of two ways. It can be returned in cash, okay, meaning for every share that that you own, you'll get, like in this case here, this dividend is like 121. I'll use that. So the dividend ended up being $1.21, meaning for every share that you have, you're going to get $1.21 back as return on your investment. Or it can be issued back as a stock dividend, meaning instead of getting cash back, the company will give you additional shares of stock. Okay, so if you had 1,000 shares of stock and they decide to pay a stock dividend, well then maybe you end up with, they give you an extra 12 shares of stock. I'm just making numbers up, but you get the idea. So now if they give you a stock dividend, you actually have 1,012 shares of stock instead of just your 1,000 because they decided to pay back a stock dividend. They could have paid let's just call it $12, as a dividend and gave you that cash back, and then let you decide whether you want to buy more stock or you keep it as a capital gain and get taxed on it and be able to use that money. Okay, but if it's given back to you as a stock dividend, you just get additional shares of stock. All right. Okay, now I have to talk about something called cumulative and in arrears. Now remember, we had this here situation. We have preferred stock comes before common stock. Okay, and if I have, let's say the company decides to pay out $20,000 in dividends. Okay, well, and we'll get into this. Let me see. I'll get into it. We're going to get into it in a little bit, but just so you know that this 20,000, depending upon what happens, the way the preferred stock is set up, the preferred stock is going to get paid first because it's preferred, and depending upon how it's set up, even though a dividend is paid 20,000, um, maybe it's not enough to pay off all of the preferred. Okay, meaning It's easier to give a quick example. Let's say in year one, there's no dividend paid, but the preferred stock says they're supposed to get dividends. Well, that means none of the, since no dividend was paid, the preferred stock is going to be owed dividends. Okay, and that what they're owed is called in arrears, meaning it's back owed. Okay, so then in year two, let's say none is paid again. Well, preferred stock is still building up. Now they're owed year one plus year two. Okay, that's in arrears, and that's cumulative. It's building up. Okay, it's adding 1, 2, and 3. Now, when we get to year three, let's say they're paid the $20,000. Okay, well that $20,000 has to now go back and pay off year one first. If there's any left over, it gets paid off to year two. If it's any left over, then it gets to in year three, and then if there's any left over, the remainder goes to the common stock. Now, this is hard to talk about because the scenarios can be extremely varied. Okay, it's not, it all depends upon how the preferred is set up. There's no one set rule. It's not like common stock where you sit and say, okay, I buy, 100 shares and that's all there is to it. With the preferred stock, there's a lot of, they can have a lot of stipulations and, as to how things work. Okay, and that's why it's preferred stock. So there's a lot of idiosyncrasies, and it's hard to just talk about them in a blanket statement. Okay, but when you see them, pay attention to what's being said, and I'm going to go into an example of it a little bit later on. Okay, all right. So with that said, I'm going to stop the video again here, and then we'll look at this here stock chart here at the bottom.